Welcome to the Deep Dive. Today, we are taking a scalpel to one of the most anticipated and honestly most confusing tech prints of the quarter.
GitLab, ticker GTLB.
That's the one. Their third quarter fiscal year 2026 results. The after-hours call was on December 2nd, and it just sparked immediate volatility. We're here to cut through all that noise.
Right. Our mission today is to pull out the key metrics, really understand the mechanics of this aggressive pivot they're making toward AI.
And decode the big contradiction.
Exactly. Why did the stock sell off so hard right after reporting what looked like a significant beat on the top and bottom lines? We need to find the signal in that noise for you.
Okay, let's jump right in with the headline numbers because they really do tell a story of, powerful execution.
They do.
Revenue came in at $244.4 million. That's up 25% year over year.
And it comfortably beat the consensus, which was sitting down around, $239 million?
Right. And on top of that, their adjusted profitability looked phenomenal. Non-GAAP EPS was a really strong 25 cents.
Way ahead of the 20-cent consensus.
So if you just looked at those two metrics, you'd think this stock should have been up 10%? Easy.
But it wasn't. It dropped 8, maybe 9%. And the reason for that caution is really rooted in the, let's call it the quality of the earnings.
Okay.
Because while those non-GAAP numbers were great, the company took a big step backward under generally accepted accounting principles. GAAP.
About the GAAP number.
GitLab swung to a GAAP net loss of $8.3 million. That's negative 5 cents per share. And that right there is the financial sticking point.
That GAAP loss is the anchor that just dragged sentiment down. So for everyone listening, can you just clarify why investors fixate so heavily on that GAAP figure when the adjusted numbers look so good?
Sure. It really comes down to what the adjustment is hiding.
Mm-hmm.
And for high-growth SaaS companies like GitLab, it's overwhelmingly stock-based compensation, or SBC.
Right.
Non-GAAP earnings basically pretend that expense doesn't exist. They argue it's non-cash. But stock grants are a very, very real cost of doing business. It dilutes existing shareholders. It's a huge part of how they pay people.
So the market isn't really criticizing their ability to sell software.
No, not at all.
It's criticizing their spending structure.
Precisely. That $8.3 million GAAP loss, which remember is a reversal from a profit last year, it just signals to the market that, okay, while you're operationally disciplined, you're spending real long-term shareholder value to fund employee pay. And that introduces some skepticism.
Okay, let's pivot to that internal tension then. Growth versus profitability. Because if the GAAP loss is the bad part, the rest of their margin performance was otherwise spectacular.
Oh, it was a stellar performance on the efficiency side. Management was clearly aggressive with their spending. Their non-GAAP operating margin shot up to 18%.
Which was way above guidance.
Way above. Beat their own guidance by 500 basis points. And importantly, they weren't just profitable on paper. They generated real cash. Adjusted free cash flow margin was positive at over 11%.
So they're financially sound.
Very. They're sitting on a fortress balance sheet.
Yeah.
About $1.2 billion in cash and investments.
So if they're so efficient with operating expenses, where is this expensive investment happening that's causing the GAAP loss? You said it's a critical trade-off.
It lives in the gross margin. So that's the profitability of the core product itself before you get to OpEx.
Got it.
And we saw the non-GAAP gross margin contract by 200 basis points year over year. It settled at 89%. And this is a direct, very deliberate result of spending more on AI and cloud infrastructure.
Okay, so to recap for everyone, the short-term cost is intentional. They're sacrificing a bit of immediate product margin to fund their AI future.
That is the central debate. Is the market right to worry that they're trading known profitability for a speculative AI future? And you see that tension in the customer health metrics, too.
That's a good transition. Let's talk retention. What did the dollar-based net retention rate, or DBNRR, tell us?
Well, it moderated a little bit down to 119% from 121 last quarter.
Which is still very healthy.
Oh, absolutely. 119 is great. It means existing customers are spending 19% more than they did last year. But any deceleration, it worries investors who are just obsessed with hypergrowth.
But the big customers are still coming in.
The enterprise picture is robust. Customers spending over $100,000 in recurring revenue grew 23%. They're at over 1,400 now. That's a powerful signal that platform consolidation is really happening.
And management kept talking about this ultimate tier. Remind us why that specific tier is so critical for them.
The ultimate tier is where the real money is. It's now 54% of their total ARR, so it's the majority revenue driver.
Right.
And it's critical because it bundles all the most advanced security and compliance features. This tier was in 7 of their top 10 biggest new deals this quarter. Enterprises are buying the whole suite now.
Which brings us right to the core strategic story AI. The CEO, Bill Staples, he's framing GitLab as a mission-critical AI-native DevSecOps platform.
Right. And this is where we get to the AI paradox. It's maybe the most fascinating thing in this whole report.
Okay, what's the paradox?
Management said that all this generative AI out there, Copilot, Claude, whatever, it's causing an explosion in code creation. Their own activity metrics, things like CI pipelines run, deployments, they're up a staggering 35 to 45% year over year.
Wait, hang on. If customer activity is surging 45%, but revenue growth is at 25%, and DBNRR is slowing down, doesn't that suggest there's a huge disconnect? Why aren't they more worried?
Oh, they are worried about the monetization gap. That's exactly why this paradox is so central to their strategy. All this new AI-generated code, it needs more of GitLab. It needs validation, security checks, governance.
So GitLab becomes the toll booth.
The quality control gate, yeah. But until now, all that activity has only increased their costs. It hasn't increased their revenue because the model is based on seats, not usage.
So how do they bridge that gap? 45% activity growth versus 25% revenue growth. That's the billion-dollar question.
The answer is the Duo Agent Platform. That's the core of the new strategy, and it's on track for general availability soon. It's basically an orchestration layer with an AI catalog where customers can plug in different agents, Claude, OpenAI, Google Gemini, and manage them all within GitLab.
And this tech shift is forcing a business model shift, away from the old seat-based pricing. This is where the risk is highest.
Absolutely. Changing your monetization model is always risky. But they have to. They're shifting from pure seat-based to a hybrid model, seat plus usage-based.
So you pay for the seat, and then you pay for what you use.
Exactly. This is the key to finally monetizing all that explosive platform activity. The new model will even encourage customers to pre-commit to usage credits to get better rates. It aligns cost with value.
But hold on. If 70% of their revenue comes from self-managed customers, how quickly can they even adopt this new platform and start generating that usage-based revenue?
That is the single largest timing risk in this whole story. Self-managed customers have to go through an upgrade cycle. It's not instant. It can take multiple quarters to ramp up. The market is pricing in that uncertainty right now.
Okay, before we get to the guidance that really sealed the deal for the sellers, there was a big governance update we should mention.
Yes, a very important one. The new permanent CFO, James Shen, the interim CFO, is stepping aside, and they've appointed Jessica Ross.
Formerly of Front Door and Salesforce.
Right. She starts in January. This closes a really material governance gap that's been an overhang on the stock for a while. It signals maturity.
Okay, let's talk about the forward look, because this is where the stock really took a nosedive. What did that Q4 guidance say?
Yeah, the Q4 outlook was the immediate trigger for the sell-off. Revenue guidance of $251 to $252 million. It implies a really sharp deceleration in growth.
Down to what?
Down to about 19% year over year. That's a big drop from the 25% they just posted. And the market trades on the margin, you know?
Oh.
That deceleration was a major red flag.
And when they gave that conservative outlook, they pointed to 2 very specific things, not just the macro.
Which is important because it means they might be temporary. First was persistent weakness in the SMB segment, small and medium businesses.
Which is a small part of their business anyway.
Tiny, about 8% of ARR. The second, more influential factor was softness in the US public sector.
The federal government?
Yep. They cited specific procurement delays, budget noise from the government shutdown. Basically, deals that were supposed to close in Q3 got pushed into Q4.
So you have a company that just beat on revenue by 25%, has stellar non-GAAP profits, sits on a huge AI advantage, and the stock drops nearly 10% because of a near-term slowdown. What does that tell you about the investor mindset right now?
It tells me the market is operating with extreme, almost irrational skepticism about timelines. They're trading this as a great quarter, but we're unsure about tomorrow's story. They completely ignored the 45% activity growth and punished the stock for the three immediate pain points.
The Q4 deceleration, the gap loss, and the moderating retention rate.
Right. They're prioritizing near-term financial cleanliness over what looks like a massive long-term strategic advantage.
So the central question for you, the listener, really boils down to this. Will this expensive, disciplined investment in the Duo Agent Platform successfully convert all that developer activity to real, usage-based revenue fast enough before the market just loses patience?
And remember that friction point. 70% of revenue is self-managed. That ramp will be slow. The market knows this.
That brings us to our high-conviction, high-risk segment.
This is not financial advice. I repeat, this is not financial advice. We are strictly looking at market structure and volatility.
Okay, we are pitching a trade based on the market's overreaction. I'm calling it the short volatility on the AI monetization thesis.
I like it. Lay out the rationale, because shorting vol after a big drop feels aggressive.
The rationale is that the stock is just plain oversold.
Yeah.
The drop was driven by temporary headwinds, mostly federal delays. The market is severely, and I mean severely, underappreciating that underlying signal, the 35 to 45% growth in CI pipelines. That is guaranteed future monetization.
And we saw an imbalance in the options market. Right. Implied volatility was pricing in a huge move, something like plus or minus 13% for the week.
And the actual move was much smaller.
Much smaller. So that fear premium is now baked into the current options prices, even though the fundamental story probably puts a floor under the stock here.
Exactly. So the proposed trade is to capitalize on that fear premium. Sell near-term out-of-the-money put options. For instance, look out 30 days. Target a strike price well below the current level, maybe below $35. You're wagering that the long-term AI story prevents another major drop from here.
So you collect that juicy premium, betting that the Q4 bad news is fully priced in, and the sheer momentum of platform activity keeps the stock from falling further before the next positive catalyst, like the Duo Agent GA, finally arrives. Plausible, but definitely aggressive.
So as we wrap this up, let's circle back to the core tension you need to internalize. GitLab delivered on immediate profitability in non-GAAP terms. They are making smart AI investments.
The market has zero tolerance for deceleration right now, and it's demanding immediate proof that those investments will turn into re-accelerated growth and crucially sustained GAAP profitability in 2027.
And that leads us to our final provocative thought for you to chew on.
Will the appointment of a seasoned external CFO like Jessica Ross finally close that execution and governance risk that's been shadowing the stock all year? Or will the market just continue to see this as a high-risk story, no matter who is managing the books?
A fantastic question to ponder. Thank you for joining us on this deep dive into the GitLab earnings call. We encourage you to review the information and continue your own learning journey.